Okay, I think we'll go ahead and get started now. Um, First, I'd like to say thank you all for joining us. We're excited to be here today for the first of a two-part series about art and estate planning. Today's session focuses on lifetime transfers of art. Specifically, we plan to discuss gifts of art to revocable trusts, considerations when selling art, gifts of art to charity, and active management of art collections. If you have any questions as we're talking, please put them in the chat and we'll leave some time at the end to answer any questions. Also, we'll be recording this presentation, so if you want to go back and re-listen, the link will be emailed to you after the presentation. I'm Amanda Cruz. With me is my colleague, Stephanie Vara. Stephanie is going to kick us off this morning by talking about gifts of art to trust.
Good morning, everyone. Gifts of art to irrevocable trusts. Art can be a great asset for some individuals to donate to an irrevocable trust, including a GST-exempt trust. It has high appreciation potential. It's an asset that many individuals may wish to keep within the family for multiple generations, and it does not require that the donor part with liquid assets that he or she may need in the future. However, before making a lifetime gift of art to an irrevocable trust, there are some issues to consider. First, where is the art going to be kept? Who's going to be using it or enjoying it? If the art is placed in storage or hung on the walls of a beneficiary's home, this isn't really an issue. But if the art is hanging in your home and you intend to keep it there after gifting it, you will need to rent the art back for its fair market value. Otherwise, you risk that the art is going to be included in your estate under Section 2036 of the tax code. This section provides that the value of the gross estate includes the value of all interest in property that the decedent has transferred for less than full and adequate consideration and retained the possession or enjoyment of. Before gifting art that you want to keep on your walls, it's also important to think about the ongoing administration and costs associated with the rental. So rental agreements are going to require that you pay rent to the trust. It has to be renewed every 1 to 3 years. And when renewed, you are going to have the art appraised. In addition, because art is difficult to value and there can be a lot of value at stake, you're going to want to use a well-respected and qualified appraiser. Rent is also considered income. If the trust is a grantor trust, the rental transaction will be disregarded for income tax purposes, and the rental can be a way to deplete your estate and transfer assets to descendants without taxes. But not everyone is willing to take on the income tax burden of a trust for descendants. If the trust is a non-grantor trust, then the trust will need to pay income taxes on the rent payments. Second, you want to think about how and when assets will be divided among beneficiaries to keep things fair and equal. Art is a unique asset and only one copy of an artwork may exist. Or if it is part of an edition, you probably only own one copy. Different artworks can also have very different monetary and sentimental values. And most long-term trusts for descendants are set up to divide into separate trusts at some point, whether it's the death of the grantor or maybe the death of a primary beneficiary. So you should ask, who's going to be responsible for dividing the art? Is it going to be the donor? Is the donor going to do this through a letter of wishes or directly through the trust agreement? Is the trustee going to do it? Or maybe the beneficiary should do it by agreement or taking turns selecting objects. Maybe an independent third party, the type of person that you'd select as a trust protector, should do it. Once the art has been divided, is a top-off or an equalization going to be necessary? Are there sufficient other assets for a top-off or an equalization? And do beneficiaries have very different lifestyles or spending habits? It's important to think about these things before it comes time to divide the art and to build flexibility into the trust agreement with respect to how and when things are going to be allocated. Some people, particularly a corporate trustee or an independent trustee, may be reluctant to take on this responsibility, or some beneficiaries may be prone to conflict or disagreements, particularly if someone, such as a parent or spouse, has just died and emotions are running high. And if one beneficiary has a strong emotional attachment, that could be to one of the works, that could be another issue. Some beneficiaries may also spend way more of the pooled assets over time than others. There is no one right answer, and the right answer will vary from family to family. However, putting some thought into this in advance can help to reduce conflict among beneficiaries and to relieve some pressure for the trustee.
So if you're opting to sell art during your lifetime rather than gifting to a trust, caution should be exercised, not only because of the market, but also because sellers of art receive different treatment under the tax code from sellers of other appreciated assets. So unlike gains from selling stocks or bonds, which are taxed at 20%, gains from the sale of art and other collectibles are taxed at 28% or higher. In addition, the tax code treats sellers differently depending on their relationship to the art. Tax treatment varies depending on whether the IRS classifies the seller as an artist, a dealer, an investor, or a collector. Not surprisingly, artists are those who create works of art. Income from art sales for artists are treated as ordinary income, and expenses are deductible if they're incurred in the normal and ordinary course of business. However, most art sales are classified as collectors. The IRS defines collectors as those who appreciate art and accumulate it for personal enjoyment. Gains on the sale of art are generally treated as capital gains, and expenses for acquiring and maintaining art are not deductible. A dealer is a person who regularly buys and sells art as a trade or business. When determining if someone is categorized as a dealer, the IRS considers things like sales efforts and intentions when buying a piece of art. The seller must demonstrate that his interest in art is not just a hobby. And this is important because expenses and losses associated with the hobby are not tax deductible. Like dealers, investors must also show that their interest in art is more than a hobby. To be classified as an investor, a profit motive must be of the highest importance. So to make this classification, the IRS will consider things like the purpose for which the piece was acquired, the length of time of possession, the investor's other business interests, and the use of the proceeds from the sale of each work. To be an investor, an individual must sell or be willing to sell a piece of art for profit. And this is crucial. So the IRS has denied many individuals investor status because they couldn't document or show that they had ever sold a piece from their collection. Dealers and investors are both primarily motivated to make a profit. So how does the IRS differentiate? The IRS looks at things like for what purpose the art was acquired. In other words, was it a quick resale to an end consumer, indicating dealer status, or was it to hold over a period of time to allow for appreciation as an investor would? The IRS also looks at the frequency of sales. Dealers try to turn over inventory quickly, unlike investors who hold artwork over long periods to benefit from appreciation. Another factor considered is the immediate use of the sale proceeds. Dealers are much more likely to reinvest sale proceeds immediately in new inventory, whereas investors are more likely to be patient and wait for the right piece in which to invest. Oops, sorry about that. Also, the IRS may look at the business of the seller. Investors tend to be engaged primarily in other businesses or professions, whereas art dealers are predominantly involved in the purchase and sale of art. And lastly, the IRS may look to the time and effort spent by the seller to find buyers. Dealers generally spend a considerable amount of time on advertising and the like, while investors typically do not. So all that said, our suggestion to you and your clients is to really take the time to figure out how your interest in art will be classified. This difference could mean paying up to an additional 20% in tax. And doing this on the front end will allow for better, more informed decisions when it comes to selling art. To illustrate my point, look at the difference a year can make. Works of art held for 1 year or less are subject to income tax rates of up to almost 40%, while works of art held for more than 1 year are taxed at a maximum rate of 28%. There may be an additional 3.8% tax on net investment income if the seller or the taxpayer exceeds certain income thresholds. Worth mentioning are several other considerations that can often be overlooked. The first being state sales tax. Sales tax rates vary from state to state. For instance, residents of Montana are not required to pay any sales tax, while the residents of New York City must pay almost 9% in sales tax. Also, don't forget about customs duties when dealing internationally. In the United States, imported goods are not subject to any custom duty, but some countries impose significant import duties. China is a perfect example where, depending on the province, may impose up to a 50% import rate. And lastly, be careful about selling prohibited items. Prohibited items may include cultural artifacts or works including endangered or protected species. Cultural artifacts might include things like Nazi looted art, or certain Native American artifacts like items taken from burial grounds. Also, be careful about selling art containing items like endangered species or other prohibited materials. Here, think items containing ivory. Or I recently administered an estate that included a pair of taxidermied hawksbill turtles. And the executor of this estate attempted to sell the stuffed turtles through Christie's until Christie's notified her that it would be a violation of a federal statute and she could be convicted of a felony for doing so. Another more famous example is Robert Rauschenberg's Canyon painting, which included a stuffed bald eagle, a bird that's under federal protection. This painting was part of Robert's estate. However, his heirs can't sell it, which is a shame because the IRS valued this piece at over $65 million. It now hangs at the Museum of Modern Art in New York. I say all of this so that you or your clients are fully aware of the many factors that should be considered when contemplating selling art. As I mentioned, knowing these things at the outset allows for better, more informed decisions in regard to the management of art collections as an investment.
Moving on to donating art to charity. Art collectors often desire to donate art to charity. Charitable donations are attractive, especially in the case of highly appreciated art, because of the charitable income tax deduction. However, before donating art to charity for tax reasons, donors should think about how valuable the deduction actually is. There are limitations on the amount that an individual can deduct for a donation to charity that depend on the nature of the charitable recipient and the nature of the property. The rules for determining the amount of a charitable deduction are very complex. The chart in this presentation are intended to provide a brief overview and comparison, just as it relates to art. So in general, an individual can take greater deductions for gifts to public charities or to donor-advised funds than for gifts to private foundations. For gifts of art, this generally means that each year you can deduct up to 30% of your contribution base, which is generally your adjusted gross income, for a gift to a public charity like an art museum, but only 20% of your contribution base for a gift to a private foundation. In addition, in the case of art, the related use rule is an important consideration that determines the amount of the deduction that you receive. The related use rule provides that where tangible personal property is donated to an exempt organization, including a public charity, you can only take a deduction equal to the fair market value of the property if the organization is using the property in a manner related to its exempt purpose. Otherwise, the deduction for the donation is generally limited to your tax basis. So to illustrate how these rules work, let's assume that a donor wishes to donate a painting with a fair market value of $1 million and a tax basis of $500,000. The donor has $1 million of income every year and is not making any other charitable donations. If the donor donates the art to an art museum and the art museum puts it on display, the donor will get a deduction of $300,000 in the year of the donation. And because of the 5-year carry forward for unused charitable income tax deductions, the donor can deduct the remaining fair market value over the following 3 years. So over 4 years, you will get $1 million of tax deduction. In contrast, if the donor donates the painting to an art museum so that the museum can sell the painting at auction and use the proceeds to pay for operating costs, the donor's deduction is limited to basis. So the donor can deduct $300,000 in the year of the donation and $200,000 in the next year. So that's half of what the donor would have been able to deduct if the museum had instead put it on display. And if the donor instead donates the painting to his or her private grant-making foundation, he or she can deduct $200,000 in the year of the donation, $200,000 in the next year, and then $100,000 in the following year. So the deduction has to be taken over more years. And if the donor had instead donated cash this year to the museum, the donor would get to take a $600,000 deduction this year and a $400,000 deduction next year. All of this is to illustrate that the amount of the deduction is something to consider, and maybe a donation of art won't be the best way to maximize a charitable income tax deduction. But then again, art may be the only asset that the donor is willing and able to part with. And as we all know, taxes aren't the only consideration either when donating art to charity. Some people genuinely want to make an impact. Oh, Amanda, can you go to the next slide? Some people genuinely want to make an impact. For others, leaving a legacy also really matters. When donating art to charity, a donor and a donor's advisors should think about the donor's goals and make sure that the final agreement achieves them. Here are a few of the most important non-tax considerations which should be addressed in a negotiation. So the first is acknowledgement. For some donors, recognition and consideration of a gift is really important. Recognition could be in the form of an acknowledgement or dedication on a gallery label, in a publication, or by naming on a gallery, wing, or building, or in the whole museum. Is it important for the donor to be recognized in perpetuity? This should be discussed in detail in advance and expressly covered by any agreement between the charity and the donor. After the negative press surrounding the Sackler family, charities are reluctant to grant naming rights in perpetuity, and many will not do it unless the gift is significant enough to them. And perpetual acknowledgement probably will not be included in a draft agreement unless the donor requests it. Similarly, if a museum gets a much larger subsequent donation or demolishes and rebuilds a gallery or building using a later donation from a different donor, the museum could rename a building after the second donor unless the agreement with the first donor prevents that. Alternatively, some donors want their gifts to be anonymous. If a charity receives a significant donation, it is usually eager to recognize the donation publicly, and not just through a gallery plate or naming, but through press releases, print publications, and social media. If the donor does not want any recognition, that should be discussed in advance and put in writing. So another factor is retention and display. And this is somewhat similar to recognition. Is it important to the donor that the museum display the art? Is it permanently for a minimum amount of time or a certain number of years? A museum may not have the gallery space or storage space for a work of art, or displaying the art may be difficult and costly. For example, Donald Judd wall sculptures, which can weigh several tons. A gift of art may not be in line with the museum's recent collecting patterns or meet its provenance requirements. And a museum may be inclined to sell such art or to keep it in storage unless required by a gift agreement to retain it or to display it. So display and or retention should be negotiated in advance and expressly covered by any agreement. Another consideration is conservation and preservation. Some works of art are very old, are made of unstable materials, or materials that are difficult to preserve or require unique knowledge and resources. For example, Dan Flavin's neon light sculptures or Nam June Paik's TV sculptures. These are outdated technologies, and not all museums have the experts or the funds to properly conserve works like this. Outdoor sculptures are also exposed to elements such as snow and rain that can damage them. Oftentimes, a museum won't accept a work if it can't take care of it, but if the work has sentimental value to the donor may wish to discuss conservation and preservation with the museum before donating it anyway. And the last consideration is use and enjoyment. Once you gift a work of art, it no longer belongs to you, and in general, you can't hang it on your walls indefinitely and enjoy it. Although there are some very narrow exceptions for gifts of fractional interest, once you've donated it, the art is gone. And for this reason, you may wish to simply loan or pledge art instead of donating it.
Lastly, I'd like to speak briefly about actively managing art collections. So imagine you're at an auction where you see two similar pieces. One is simply titled Man on Street 1845. The other is titled Man Standing in the Street Surveying Damage from the Great New York City Fire, 1845. The second piece includes details on the artist's involvement in the efforts to rebuild the city in the years following the fire. You're told the artist's father was a volunteer firefighter. Records show that the first recorded owner was Bob Smith, a retired New York City fire chief. Bob lent the piece to the New York City Fire Museum, later to the Boston Fire Museum, and most recently to the Museum of Modern Art in New York City. Through its meticulous purchase history, the second painting's value has increased fivefold. So this is a perfect example of how maintaining and authenticating provenance can have a direct correlation with the value of the piece. In addition to assuring you're maintaining your records for each of your pieces, there are a number of other things that art owners can do to increase the value of their collections and in turn increase the value of their wealth. The first being loaning their pieces to collections or museums. Having an artwork featured in a major art museum is one of the best things that can happen to a piece of art. Every piece of art that's listed for sale at a prestigious auction house has an accompanying list of major exhibitions where it's been shown. The more prestigious the venue, the higher the price. Further, art owners should also physically protect and insure their art. With regard to conservation, this goes without saying, but take good care of your art. You probably already know to do the following, but I think they bear repeating. Simple things like keeping your pieces out of direct sunlight or storing your art in rooms with climate control, not storing your art on the floor, and using professionals to clean, repair, or prepare art for storage. Next, insurance. Ensure your collection has adequate coverage. Typically, this is done through special coverage with the collector's fine art insurance policy. But be sure to validate that your policy covers potential risks. For instance, if you store your collection or pieces in your basement, just be aware that you have coverage for flooding if that is a possibility. Something else to think about, if you have any concerns about the acquisition of your pieces, consider effective title coverage or insurance that will cover the amount you paid for the work if it should turn out that there are issues with provenance. If, for instance, a piece in your collection has been determined to have been previously stolen. Also, you want to regularly review your coverage to ensure it's accurate and up to date. Your values change sometimes very rapidly. Has an artist died and the value of your pieces significantly appreciated, or throughout the course of the year, have you acquired several new pieces that aren't covered by your existing policy, or replacement would exceed your coverage value? As you know, all these things may affect the value of your collection, which may require updates to your insurance. My last point is in regard to appraisals. Be sure to have regular appraisals of your collection. This seems really simple, right? But you'd be surprised how often folks neglect to do this. This is particularly important, with works that are bought for investment. It allows you to keep on track with the value of your collection. In addition, regular appraisals allow you to coordinate with insurance to further assure you of proper coverage amounts. And, just knowing the value of your collection gives you a sense of whether pieces or collections are ripe to gift to trusts, families, or charities. Doing all these things will help maintain the collection, it will increase the value of the art investment, and consequently build wealth. You have any questions in the chat, Stephanie?
We just have one question. So someone asked, how does sales tax apply in Minnesota if you are a Florida resident, but you purchased a $20,000 piece of art at an art fair for your second house in Minnesota? So the rules for sales tax are complicated because it depends on where you're buying the art and where it's being delivered. So it's kind of hard to answer this question without more information, but something to keep in mind is that it's, where you buy the art is going to be a factor and where it's going to be delivered, purchased in Minnesota. So if it's being delivered in Minnesota, then Minnesota sales tax should apply. Because the piece of art is, and I'm licensed in Colorado and New York only. Amanda, I don't know if you can speak more to rates in Minnesota, but generally it would just be Minnesota sales tax, like if you bought an apple at a grocery store or something, because you're buying it in Minnesota and it's being delivered in Minnesota.
Right.
And that is the only, let's see, I work with potential donors to my institution. They often have to have a very, very hard time finding appraisers for the collections. Do you have any advice I can pass on to them? I know a number of appraisers working in estate planning, and I'm sure we would be happy. Our firm has a ton of connections, and we'd be happy to introduce you to any appraisers if you need. Another thing is to also talk to auction houses. So estates that I've worked on in the past, a lot of the appraisals were done by the auction houses that were also selling the work, and they are happy to do that as like a supplemental service in addition to selling the art. So that's one place to look. We're also happy to talk about both of these questions more in detail after. Those are the only two questions we've gotten so far. Does anyone have anything else that they want to ask before we wrap up? Is it worth appraisal every 3 years if the art is going to charity when investor dies? It probably matters less because of the estate. So there's an unlimited gift and estate tax charitable deduction, which we did not talk about in this panel because it's not, because it's unlimited, it's not going to be as much of a factor as an income tax charitable deduction or necessarily as valuable. So probably not, but it really just depends on the work of art and, how many years away is this? Would you consider donating it beforehand? Do you have other resources that you need for yourself? Like, are you going to potentially consider selling it instead of donating it to charity? So it really depends, but it's probably less important in a case like that.
Although I will say, for if for nothing else, to coordinate with insurance to assure you have coverage. If there were, some type of natural disaster or fire, if your replacement value is significantly off from what the art has appraised at recently, you'll receive less from your insurance payout than you would.
Art is held. So it's held by MIA on loan. So probably if your loan agreement with them, they're responsible for insurance, then I think probably matters less in your case, and they should be responsible for that. But you need to read the agreement and take a look at the agreement again to make sure that there's going to be adequate coverage, because every loan, every donation is different. Okay. Those are all of the questions that we've received, and it's 9:29. So I think we will wrap up now, but if anyone has any other questions after the session, feel free to email us. Our emails are listed on the screen. And we are doing another session on testamentary planning on Thursday, September 30th. So I hope that we see everyone there. And if there is anything in particular that you'd like us to discuss in that session, also feel free to email us about that, and we'll try to incorporate it. So thank you, everyone. Have a good morning.